Welcome to the Retiring Real Estate Investor Podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice. Nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Welcome to another episode of the Retiring Real Estate Investor Podcast. I'm your host, Brandon Bruckman. I am joined by Ian Lang from Locke Funds. How are you, sir?
I'm doing well. Yourself?
Phenomenal. This is a special day for us because usually we're talking about syndications and a lot of things related around real estate. Today we're going a little bit different and into an area that I think we're really interested in as a firm, and we found a lot of our clients are as well. We're going to talk a lot about oil and gas, and Ian's going to sort of walk us through, what that means. I recently posted something on LinkedIn that got some weird sort of responses. I was talking a lot about the incredible tax benefits on oil and gas, and the comments were littered with, yeah, that's great, but oh, so risky. And I kind of giggled in my mind because the people commenting, bless their souls, are the same people who make fun of the general public when they talk about real estate being risky. I'm like, oh, this is all stemming from the same place of not understanding the investment deeply and what we're talking about. Sure, it seems too risky from the sidelines, but maybe we'll dispel that myth today. Sound like a plan?
I like it. Sounds like a great plan.
So maybe start us off. Tell us your background, where you came from, how'd you end up in the oil and gas space?
Okay. Yeah. Me personally, I went to University of Kansas, a finance accounting degree, started my career in M&A consulting, and then was at JP Morgan for a little bit in high net worth, ultra high net worth, money management, wealth management. And then backed my way into oil and gas business. And I knew that I loved the industry. I had the opportunity to intern in the NYMEX in college and in New York, and knew I loved the industry, knew I wanted to figure out a way to get in. Just never quite figured out the avenue to do it. So had an opportunity to take a leap of faith and leave my fancy business card and suit behind, and went and started working as a day rate landman, using the analytical skills and making phone calls and trying to buy deals. I did that for 3.5 years with, I guess I could call him my mentor. And around that time, my business partner now, David Nicoloy, and I had an investment thesis centered around the arbitrages in the oil and gas business on the mineral side of the game, and being able to use 1031 exchanges to roll into commercial real estate. And so we started that at the beginning of 2015 and had some quick success. We're off to the races, and our company has evolved a lot since that happened, but we've kind of always tried to stay true to the investment thesis of looking for tax deferrals, tax deductions, and ways to minimize ours and our investors' tax liabilities. So obviously you want to give massive returns with that too as well. So, and those are our goals. That's kind of, I guess, Locke's background in a nutshell.
No, I like it. Talk to us about, I want to piece some things out there so listeners can sort of understand. So think about someone coming new to this space. There's a difference between mineral rights, which you had mentioned in your comments, and then working interest. Can you describe that for listeners?
Absolutely. So mineral rights are going to be your subsurface ownership. You have, if you own a farm or a piece of land, that you're going to deed that into your name and you're going to own the actual surface rights. Those are yours. You can go build a house on it, road, hunt, whatever your goals are with that. Minerals are really no different, just you can't see them. And so you own the rights below the surface, and those rights can be manipulated. They could say, hey, you only own the water rights, or you only own the fossil fuel rights, or you own all right, title, and interest to everything below surface. But in general, it's just the subsurface land rights, and you own those in the right locations. And there's a lot of black gold, if you will, oil subsurface, and the operators will come along and they'll lease you, and the lease will have a royalty interest assigned to it. So when they develop the interest, you will get a proportionate percentage of all oil and or gas produced on your interest relative to the royalty you've agreed to. And the royalties can vary from basin to basin, right? You're out in West Texas, your royalties can be 25% of all of the any fossil fuels that are oil or gas that are produced from your lands. And if you're in Colorado, it could be 3/16, right? It's just kind of what the play holds, what the economics support. And obviously, from a landowner perspective, we're always trying to push that royalty higher. So now in non-op, go ahead. Sorry.
Yeah, no, I was prompt you. So
Okay.
that's all right. That's below the ground. And then maybe ask a question there. If that's below the ground, what are my control mechanisms? I'm at the behest of the operator on that parcel of land, and they're making decisions about when to drill, how much to drill. What are my control mechanisms there as a mineral rights holder?
Well, so minerals they're a passive ownership. It's a passive investment, and you're going to buy the mineral interest, and that's going to be your one-time expense for the interest. From there, the control you might have as a mineral owner would be in your lease negotiations, right? And so when an operator comes along and they want to lease your interest, that's your opportunity to say, hey, look, great, we're really excited to have you come explore and develop, but these are the kind of things that I would like to see. And you can negotiate the term of your lease, you can negotiate the royalty, you can negotiate how they're going to extract the gas, and some of the within reason, right? They're not going to let a mineral owner control and how they do business, because they have other opportunities, right? You don't want to de-incentivize them to develop your mineral interest, but that's your opportunity to go in there and do everything you can to protect your asset and make sure you're maximizing your value.
Mm-hmm. So for reference, see the movie There Will Be Blood. You're on the other side of the table of Daniel Day-Lewis.
Bingo.
You're the mill they were the mill rights holders, right?
Yep,
and then we saw on that, if you know that movie well, like I do, it's on the favorite movie list. Brandon Bruckman.
It's a great movie.
But that was the rub in that movie was, in some situations, there's a famous scene in there where he walks out of a negotiation with a town, right? Because there's other opportunities and they're making it too difficult.
Yep.
For him, right? Yep. So
or even landowners. My milk drink drinks your milkshake. If the last thing you want to do is be that landowner that is being difficult and have him develop or ostracize you. Like, hey, I'm gonna drill your neighbors and you, and I'm gonna drill above and below you into the east and the west, you north, south, east, west, and I'm really going to make it difficult for anybody else to come develop your interest. Now look, the states are involved in a lot of this, and there are mineral right protections, for the asset owners. Some states are more favorable than others, but in general, the states do a decent job at trying to protect the assets for the mineral owners, but there's still ways that operators can do things to really ostracize your interest, and so you want to play ball with them. And if you own minerals, the goal is to get them developed, right? So you want to do everything you can to incentivize mineral owners or operators to come develop.
From a high level, how is that different in a state by state for rights of mineral holders?
It's just a matter of how some states are a lot more pro operators, right? And so they're going to be a lot more incentivized to do things that allow the operators the ability to force people to sign leases or to force pool, I guess is what you would call it, right? Hey, look, if you're not going to play ball with us, the state's going to come tell us that we can do this anyway. So here are your options, right? And in some states will say no. We're going to give the mineral owner a lot more clout and protection here. So if you want to develop this, you got to figure out a way to work with them and or work around them, right?
Gotcha.
And without getting into too many details, I mean, that's just kind of the nuts and bolts of it. So we operate in primarily in Texas and North Dakota. Obviously Colorado is an area we used to operate in. That's become a very non-oil and gas friendly state from a lot of perspectives. So you try to mitigate some of your risk with depending on what you're buying, mineral interest, non-op, and or just state by state, because you understand that what states are going to help you protect your investment, and what states might not, right? So you don't want to buy something in Colorado and then realize that when an operator wants to develop it, the state won't allow them to, right?
I would not want that.
No, that's called lost money.
To round out the key points on if you're a mill rate holder, also 1031 exchange eligible. I think that's a key.
It's all real property. Yeah.
It's all real property. So all the time when we talk about, hey, what can I 1031 exchange into? It's like, yes, you can sell your farm and buy mineral rights. You can sell your multifamily building and buy mineral rights. You can sell your mineral rights and buy a warehouse. These are all interchangeable in like kind exchange, which for some people blows their hair back. Like, yeah, all this is investable real estate.
It was when we originally discovered it, we were kind of, hey, we vetted it out pretty hard too. Back in 2014 when we were really, putting our thought process together, it was, is this right? Is this, and the answer is yeah. It's, you talk to experts on the subject, and it's a great way to defer those taxes, and that's obviously I know that a lot of what you do for your clientele is making sure they don't take a great asset and have it haircutted huge by having to pay a tax bill. So being able to jump back and forth between real estate and oil and gas are obviously two amazing industries, has been very lucrative for our company. So we were excited when we figured that out back in 2014 or 15.
Yeah, it's a big deal, and it's a big deal for folks that maybe trying to diversify. A lot of the folks that we talk to are very real estate centric. A lot of our clients are, and I think the assumption is they can't get off that carousel, and for some they really don't want to. They're like, hey, it's been great. Like, why would I leave? This ride's fun. Like, keep putting the quarters in. But for others, they recognize that, taking a little bit and moving it away from the space isn't a bad idea. Having a little bit of diversification is the worst thing. And this is a very easy way to do it, especially if you're going through 1031 exchange. Like, we can really do some things here to make it a big deal.
Yeah, and we've had a lot of success. A lot of our investors, understand real estate a lot better than they understand oil and gas, and so the minerals. There's a lot of avenues and comparisons to real estate, right? Once you get past the stigma of everything's a wildcatter, right? Everybody thinks oil and gas. They think you're out in the middle of nowhere, Texas, and you're drilling a well, and you may hit, you may not hit, and once we walk people through our how we acquire, where we acquire, our prereqs, how we do our due diligence, and get people comfortable with the idea that we're not wildcatting. There are guys that are doing that, and those guys got big huevos, right? And we don't. That's not where we play. But once you get people, hey, this is, we're doing everything we can to de-risk, and you kind of start walking them through, it's kind of like buying a building and collecting rents. It's we're going to buy the right asset and work with the right partners, and once it's developed, we'll have the opportunity to collect our royalty checks or what they. I remember they first heard this 10, 15 years ago, but they call it mailbox money, right? Just walking out to your mailbox and collecting your mineral checks and your royalty checks, and that's really how simple the mineral royalty game can be.
Let's do some relation here with real estate. I think that's a really good a really good parallel to try and help people understand it. Here's ways that we see it's different, and comment and correct me. One is in return pattern. Like, we are dependent upon two things in our return pattern that are a little bit different than real estate. We're very much dependent on the price of oil and gas. So we're playing that game. And then production, which we don't have as much control over. Like you mentioned, we can do the lease, and we pick who we're doing the lease with. We don't have control of how much they're pulling out of the ground. So then what happens to our distributions become, I think, a bit more varied for real estate investors than they're kind of used to. Can you talk about how you maybe folks should sort of think about that and sort of wrap their brains around it?
Yeah, so it's a term I like to use is oil and gas is really a velocity of money, and so it's you buy real estate and you buy it for the long haul, and you clip your quality return, and over a period of 10, 20 years. In oil and gas, your return on an asset is going to be very front loaded. And it's because the day one when that oil and gas well is turned online, and they start pulling the oil out of the ground, that's going to be your best production.
Mm-hmm.
And and then you work down on your decline curve, and your decline curve essentially settles out, and is more predictable. But those first year to 2-3 years is when you're going to get a massive amount of your investment back. And so it's very IRR friendly when you know that, hey, I'm going to put $1 in the ground, and I'm going to have 60-70% of that dollar back in 2 years, right? And and depending on obviously how quickly it's developed, the success of the wells, but that's the general thought process is it's a lot more upfront loaded with your return. And then once you get your money back, it's kind of just that long-term gravy train, right? And now the gravy train, you might get those, your money back in the first 3 years on your investment, and then over the next 30 years, you might only collect, another 1.5 times your money. But it's that velocity of money, having the money back quickly to redeploy and reinvest, and which allows, at least as a company, for us and our investors, has allowed us to build our portfolio very quickly. As opposed to that, 10-15% coupon that you're clipping in real estate, and you're able to make, like I said, return of capital in 3 years or so is kind of what we target.
And that's very different for what real estate investors thinking of. Is they're thinking about, consistent steady cash flow from a lot of the assets we look at, but then they're looking at appreciation, right? And appreciation's been a big driver of total returns over the past decade in real estate. It's not the same in oil and gas, is it? That's sort of inverted. It's flipped.
Yeah. I mean, the most, in theory, if you're buying a mineral interest today and it was being fully developed, right? The day that those wells turn online is going to be the highest value that asset is going to have, right? So, because every day that oil is pulled out of the ground, in theory, there's less value in the ground, right? And so. That is one of the big variables in the I guess variables differences between real estate and oil and gas is, while it is the velocity of capital, quick return, a lot more front loaded, your long term, you're not going to see massive appreciation, right? Now obviously you could see partial development of a unit of an interest, and they might have opportunity to develop more. It'd be like buying a city block, and having it all be scraped down and saying, hey, I'm going to develop this part of the city block and put all this new stuff in, and then this part we'll wait for the city to build around it, and then we'll sell this part, right? And so there's you can play the game, maximizing your upside, your current value today, and then hopefully building some upside into it. And we've really prided ourselves on trying to acquire assets that provide both that near-term capital return, so our investors get what they're looking for, but also try to have a component to it that says, hey, look, there is some upside on this too. So we're not only are we going to have great cash flow and distributions, but we're going to have some opportunity to either develop down the road, or when the time is right, maybe parcel off and sell a piece of the asset as well.
So different plays here where you could think about ultimately when you're selling the asset and what that means in terms of return pattern. But to your point, I mean, money is coming at you up front, and that's good. From us old school Wall Street finance guys are like, oh, we get money faster. We
Yeah,
like
a
that.
lot. Yeah. I mean, if you're IRR driven, it's the
Yeah.
place to be, right? It's and it's uh, it's a unique business. The how quickly you can recoup your capital is something I still kind of like look at, and it's kind of it's really explaining that to people that have a very traditional investment philosophy is one of those things that they kind of like scratch their head, and I feel walk them through the numbers and now wait a minute, like this is how quickly. Yeah, I mean, it's not like buying a stock and clipping your dividends. It's not like your long-term appreciation and or your 8 to 10% on a real estate, or 15% depending on how you're working that or what environment you're buying in. But it's but like you said, the big variable here is the commodity price, right? And I tell people all the time, I'm not worried about getting your money back. I'm worried about, because I'm very confident in our investment philosophy, our due diligence, our ability to underwrite conservatively. Really, what I'm worried about is am I going to be able to get it back in my targeted 3 years, or is it going to be like a 5-year return, right?
Yeah.
And so it's because I'm not Locke is we are not out risking our money and or investors' capital in things that would be not prime location assets. Right? We're buying Permian Basin, Midland, Delaware Basin. We're buying in the Bakken. We're buying in the Haynesville Shale a little bit for some natural gas exposure, we're trying to stay under premier operators in premier areas as close to main and main as you can get, while also finding those value assets, right?
I was gonna have you talk about working interest at this spot, but actually I want to talk about locations now that you kind of brought it up, and where to sort of go. You mentioned some of the prime locations. Can you discuss exactly where those are for folks? Because I think the lay listener may I know now where the Permian Basin is and where these things are. I don't think folks necessarily know where those things are. So can you talk about where those are, the Main Street, the Class A spots, and then talk a little bit about how folks should think about valuations, maybe in the real estate context, right? So like everyone for the past, whatever the hot market's been in real estate for the past decade, Austin, Southeast, Orlando, and now it's like, not so sure, right? If we watch rents slow a little bit there, now folks are looking at like the background behind me, like, oh, the Midwest looks like this great place to be now. Is there a similar
Tier 2, Tier 3?
Yeah, is there a similar context there in oil and gas, or how should people think about where people are drilling or where you want to be?
So the the basins that I mentioned. So the Permian Basin is West Texas. It's Midland. The city of Midland is kind of your heart of the Permian Basin, and it's going to be West Texas all the way to the Panhandle, and then in the southeast of Mexico. That is the most prolific basin in the United States. And generally, what you see is when there is any volatility in the industry, that is kind of the safe haven for the capital, right? Now, what that also makes is you have that's the first area that you could have inflated pricing, right? And so a company like ours that prides ourselves on being hunters, not gatherers, the Permian can be very competitive, right? And because people want to hold those assets that are the most resistant to the volatility in the industry. Now, but when you consider that your tier one, let's call that your Denver or your Nashville, but then you have the tier 2 and tier 3 plays, which frankly Locke was founded playing, the DJ and the Bakken. Those plays are incredibly lucrative and not as competitive, right? And so there's a lot of value plays in those basins, but you have to, there's some other variables to go into it, right? And so obviously you have the geopolitical risk that I mentioned in Colorado, and the DJ Basin, which is in northeastern Colorado, and then the Bakken. You have it's very finite with the formations, right? You're going in and you're drilling a few formations in the Bakken, whereas in the Permian they call it stacked pay. And so right now they're chasing the Bone Spring, they're chasing the Wolf Camp, they're chasing the Sprayberry, and then now the next thing will be the Barnett, and I'm I'm blanking right now. We're in the middle of acquiring some interest. It's the next thing is going to be deeper formation. So the gift that keeps on giving is the Permian, because they know that there's stacked pay. And so you could buy mineral rights there and have them develop your formations that are the hot formations today, and then know that, in 5-10 years, they're going to circle back to your same mineral rights that you thought were a depleting asset. And all of a sudden they're going to be rejuiced because now they're drilling deeper or drilling shallower, or they've used new technology to extract more oil in the formations they've already explored. So the Permian is like, it's like, if you buy something in Denver or Nashville, it's, hey, you might be overpaying for it, but the reality is you're probably not going to, you're not going to find yourself in a situation where the city is not desirable. Whereas if you go buy something in Milwaukee or Kansas City, and growing cities that are considered tier 3 markets, you could find yourself in in the wrong position there, depending on the environment, right? So, kind of in a nutshell, I guess that there is same exact stuff happens. I would say that it's not as the formations that are hot now are the formations that were hot 10 years ago, that I would assume the basins, the plays, and I would assume that will probably be the same basins that are hot 10 years from now, right? We're not exactly discovering, huge new plays in Idaho, right? We're sure people know of existing plays in different states, but there's reasons why a lot of the resources are being deployed in 5-10 existing plays throughout the country.
Can you talk about the impact of technology in this space? It feels like we've come a long way.
Yeah. It's
have we gotten to the point where the fear of drilling a dry hole is nearly extinct? Are we not?
Yeah. If you were playing, obviously the revolution in the industry wasn't fracking, which is what a lot of people think. Fracking has been around for 75, 80 years. The real revolution was the ability to use the fracking technology and then drill horizontally into shale formations. And that's obviously been what's revolutionized American oil and gas production the last 20 years. And it's really allowed America to become the producer and the powerhouse that we've been able to become. Obviously, that technology has opened up a lot of additional opportunities within the industry, and it has made certain areas very. You never want to say, "Hey, there's zero risk of a dry hole," because you could have a dry hole or you could have other technical problems, but we aren't concerned when we deploy capital about whether there's going to be oil coming out of the ground. Like I said, we're concerned about how quickly we're going to be able to get that capital back, and that varies on the production on the well and the commodity pricing. Now there are plenty in the industry that drill dry holes, but they're the wildcatters. They're out there trying to develop a new field or a step out. They might be, hey, you're in Martin County, Texas, which is the core of the Midland Basin, and I want to go 2 counties to the north and see if I can develop a similar play up there. Yeah, you're going to be drilling dry holes there, and the risk reward is, hey, if I go find out that I can develop a new play, in a certain area, the reward is very, very lucrative. But that's just not how Locke does it. We do everything we can to de-risk to take that component of the oil and gas industry out of it, right? So I don't want to spend my money, personally, Locke and/or our investors' capital, and not have hey, great, you dump $1 million into the ground and that's dry hole. I mean, that's an experience that we haven't had, and I haven't had, period, in the 12 years I've been in the industry. Now you have had experiences where hey, the well is going to take a little longer to develop, right? Because we've had some technical problems or something like that. But we've never had the experience of having, hey, the well's dry, right? There's no oil there. And that's just because of where we buy. We're buying in areas that are proven with offsets, and our engineer is able to use the data in the area and to confirm, that we've done everything we can to de-risk the opportunity.
So I'll do a related analogy here. Then our wildcatters are VC angel investors. Yeah.
Sure. Yeah, I think
And,
that's fair.
and then Locke and similar others, you're looking at blue chip, maybe a little Nasdaq action. Maybe not the blue of the blue chips. Maybe a little Nasdaq action where you're like, I know they're profitable companies. I know these companies make money, but they got a little juice to them.
Yeah,
Is
yeah,
that fair? Is
that's
that a good
I
analogy?
think I think that's really fair. I mean, we are I'm not gonna we're not a mutual fund, right? I'm not gonna buy
Yeah.
and but
Amazon, AT&T, and like,
yeah.
boring. Yeah.
Now, I mean, look, I mean, if I can buy, if I can buy, you know, uh, Tesla and have it boom for us in the corner, in the main and main, right on the street corner, and get it at the right price, we're going to take it, right? But we like I said, we pride ourselves on being hunters. We've got to understand trends and what's going on and where operators are operating, and getting the right information to our team, our engineers, so we can evaluate opportunities. Because you like you said, you want to buy those household stocks, but you want to buy the ones that still have some growth potential that aren't mature, right? And that's how we can get our target IRRs for our investors. And it's if we were I call it the institutional money. The money that's coming in from Wall Street to the industry anymore is, they're obviously it's an alternative investment, so they're looking for an extraordinary gain, but they're doing everything they can to de-risk. So they're taking something that could be a 15 to 20% return on an IRR basis and probably getting it down to a 10 to 12% return.
Yeah.
And that's because they're paying premium dollar for the premium assets, which is fine. That's a philosophy you could do, but it's you can also buy great assets that are every bit de-risked, that will give you better returns, and that's kind of where we focus.
Yeah, there seems to be that we've talked about a lot offline. There seems to be, I don't know if I want to use the term misvaluation, but there seems to be a little bit of risk v reward here. Seems to be misaligned slightly on where the perceived risk is and where the perceived safety is. That probably gives you somewhat of an opportunity. I don't know if that was a well-formed question or thought, but you're going to
Well,
pick it up and make it one. Here it comes.
Well, I know that you and I have discussed. I mean, why Locke exists is the institutional money comes into the market and they create a bubble, right? And they've got to deploy capital, and the guys that know what they're doing on the ground floor that are willing to get out there and hustle and roll their sleeves up and find those deals. You buy those deals and you buy them right, and you cash flow them, and then when you're ready to exit, you exit to the institutional money, if you want to exit, and that because they've created the bubble, right? They're the ones that are our end user generally is the institutional investor, right? And because we want to get in there and we want to get that upfront juice, and then we want to let them have the long term annuity. Is how we've generally played our investment strategy at Locke.
Mm-hmm. That's like the finance circle of life.
Yeah, it's
It's very natural. The way things work, right?
Well, yeah, and it's funny the in the industry, like anything is, every arbitrage closes, right, or at least minimizes, right, and so the industry always has, at least how we've experienced it, there's always opportunities to find the next arbitrage within the industry, and we're always pivoting around trying to identify that, and whether it's changing our BD tactics, and or pivoting around basins a little bit. Whether hey we're going to buy up in the Bakken for a little bit here because we think that we can get better returns up here, and have the same quality operators, or or we're going to buy in the Delaware Basin as opposed to the Midland Basin, or and you're obviously actively trying to stay ahead of it, right? And Locke is kind of like a jet ski or a motorboat, right? When we want to pivot our philosophy, we can pivot quick. And whereas I think some of the larger groups, they can't pivot as fast, right? Now obviously they can money whip some of these issues, but hopefully they're buying assets from us when they're trying to do that.
Yeah,
So.
exactly. It leaves you in a favorable spot to kind of play between these different folks that are operating in the space. It's a very good thing. We have to circle back and talk about working interest. from top
Perfect.
down. I took you away from there. Now we got to.
Yeah.
So
Or
let's maybe do this. Go through what's the difference, right? So I'm looking at I have unencumbered non-1031 dollars because I can't 1031 into working interest. That's the first thing. So
Mhm.
I have cash and I want to invest. What's the difference for me between I'm looking at mill rights or working interest? How should I think about that?
Well, it's I guess the initial difference is you're going from a passive to an active investment. And working interest has massive tax benefits, and that also come with the same tax benefits that minerals come with depletion. But you are now an active equity owner in the development of a well. So we talked about minerals, us signing a lease with the operator. When you go into the non-op space, you are the one that's taking the lease from the mineral owner. So now you're negotiating the lease, or you're buying a lease that's already been negotiated by somebody else. And your goal with that is now I have the rights to participate in the development. And so when operator comes along and develops, then I own my proportionate share of that well. So you can own 0.5%, 1%, 5%. And it's just a matter of your risk appetite and your concentration of capital in that investment. But with the investment in the active component of the non-operated working interest, you get a lot of year one tax deductions.
Mm-hmm.
So how the industry is when you go drill a well, you have your intangible and your tangible drilling costs, and your intangible drilling costs are going to be year one deductions. And so the rule of thumb on that is you're going to have about 70% of your invested capital in the development of a well is going to be year one tax deductible. And then you'll have a component of that remaining 30% that you'll have some kind of a depreciation on. You will still be deductible, but it won't be in front year. You'll be deducted over 5 to 7 years. And so that's obviously a massive tax benefit when you're getting a quick return of capital. Generally that first year is when we have our highest returns, and then you have that beautiful tax deduction to offset that.
And we're not tax pros, but do discuss where I can use that tax deduction. It's not like real estate, right? Where I have to be a real estate professional to use all the goodies. I can do this almost anywhere, right?
Yeah. Well, if our investors, how we walk them through it is if you elect in the year of the CapEx to be a GP participant, so that you can offset that against your W-2 income and or your passive income. And so and that is we have investors that have passive income and they're like, fine, I don't need it, I have enough passive. But you have a lot of high earners that are investing with us, and they're like, so I can offset this against my doctor's salary, my lawyer's salary, or whatever it is. And the answer is yeah. Obviously, like you said, not tax professionals. Always tell everybody to consult with their own accountants. But this is the massive benefit of participating on the equity side as an active participant in the development of oil and gas. And we buy our non-operated working interest the same way we buy our minerals. Everything we can to de-risk, everything we can to try to have the most predictable outcome possible, right? And so it's great returns of capital, and that come with a massive tax benefit. And we haven't mentioned it, but in real estate or in mineral rights and royalties and non-operated working interest, everything comes with depletion. And depletion is just going to be 15% on an annual basis. So you get to take 15% of your top line every year as depletion, and it operates very similar to depreciation, right? And so it's but they're saying, hey, every year we're pulling oil out of the ground, so your asset is depreciating, and therefore they're going to give you compensation for that depreciation and in the form of depletion within the oil and gas business. So you have in your year one with your non-op, you have your 70% rule of thumb from your IDCs. You're going to have a portion of your tangible that you're going to be able to write off, plus you're going to get 15% depletion on any revenue you've generated. So the year one tax benefits are massive in our funds, and have been have put a lot of our investors calling us being like, no, wait, what happened here? And so it's been fun, and those are the best phone calls when you get people calling saying, hey, this is an amazing investment. This is unique and different. So
Yeah, it's a big deal. On economics then, very generally speaking, not specifically speaking, generally speaking, working interests should expect more economics because they are taking more risk than mineral right holders. Is that a fair, true or false?
yeah, we are going to have a higher threshold for obviously more risk, more reward, right? And so internally, we're gonna evaluate all deals pretty similarly in the reality of it. Our due diligence really doesn't change. And so we pride ourselves on buying things right. I mean, I'm not gonna really stretch to buy minerals either, right? I mean, even if it's the best mineral deal, if it doesn't fit our return requirements, we're just not gonna buy, right? And so you would expect, obviously you want to be more stringent, more sure when you're deploying more capital, and you have that active deployment. But we kind of, our return requirements are high, and we really try to hit those. And so you're going to have a larger percentage of all oil and gas revenue that's produced as a working interest owner, because like we mentioned, if I'm going to go to the leasehold owner and negotiate a lease with them, and I agree to pay them 25% of all oil and gas that comes out of the ground, then that means I get 75%. So I do get a larger proportionate share of the oil and gas that comes out of the ground on that lease. And so you are getting, in the event that it's a massively prolific well that makes somebody's, annual report, or if it's just your normal run of the mill well, you're going to get a larger share than the mineral owner is going to get. But you also are the one that took the risk of developing, whether it's with your Diamondbacks, your Oxys, your Pioneers, Exxons, I guess now, you're participating with those operators and you're paying those bills. So you get the lion's share of the upside.
Now you're Daniel Day-Lewis. Back to our "There Will Be Blood" example. Now,
you're on the different side of the coin here, right?
Yeah. And so it makes sense, right? So you're going to pay a portion of that revenue or profits that you generate, and we pay to the people who hold the land and mineral rights. That sort of makes sense. And so, yeah, one is watching the other do the drilling, right? And so there's a disproportionate amount of risk that one's taking over the other, and so you get economics for that. Again, economic circle of life a little bit. Things that make sense and happen naturally are sort of happening here, which is good.
Yep. Yeah. It is like I said, I mean, really what it comes down to is once you sit down and you walk a high net worth gentleman from Wisconsin, and these are obviously intelligent people. So you just got to get their attention for a little bit and walk them through what's going on and how it works, and it all makes sense. And it's and obviously differentiating ourselves from the wildcatters in the industry and some of the historical perceptions of oil and gas, right?
Yeah, and there's two of them. So I think we addressed one. I hope people get this comes through clear enough. Maybe not as clear as Elon said the other day, but so people are listening. Like, there's ways to de-risk.
We could.
we could, and I gotta do all this stuff in action to make sure we do that. So stay away from that. First time oil and gas. We're not going to break the curses yet. We haven't done that yet. So we'll try to stay away from that. But I think we've done the job. The folks can kind of read between the lines here. Like, there are ways for you to take massive amount of VC like startup capital risk if you want to. You can do that in the space, and there's ways for you not to do that if you want to in the space too. Like, it's a decision you can make as an investor.
Yep, and it's a and we have. The reality is if you're somebody that wanted to take the massive amount of risk, I'd have to try to introduce you to somebody else, right? I mean, and I hate saying that because, I'd like to, somebody that wants to invest in oil and gas, I trust that we'd be a great place to do it. But you're, if that's where you are and that's your risk profile, we could put in our back pocket, call you when we see a deal that kind of is intriguing, because we're very careful about what we might put our own money in and what we might put investor money in too, right? And I would, we don't ever put our money in something that's not very comparable to what we put investors in. But if we feel like it's slightly too risky, we won't put investor money in that, right? And so, for whatever the reason would be, and our deals that have investor money into them are consistently the same. And we have quick return of capital, line of sight development so they can get their tax deductions, tax benefits. and then the goal is for quarterly distributions. So we did a fundraise in September, and we could have done a distribution for that September fundraise in October, but we'll do our first distribution in January, and so that's so they'll get the 2023 tax benefits will be real. But they'll also have they'll need those because they're going to have substantial revenue that they'll need to offset. So but they'll get their first distribution in January for their September investment.
Yeah, not bad. Not bad.
Yeah. That's a quick timeline. Some timelines are like, hey, you're going to make an investment in September, and we'll get you your first distribution will be April.
Yeah.
But the goal is part of de-risking it is to understand that there is, we're not buying speculative things that we're waiting on. We're buying into active development, right? So something is happening now that makes this worth investing, so that we can confidently tell our investors that we're going to be able to start returning capital in the near term. And we call it line of sight development is what we call that. We got to know there's active development.
That's perfect. Here's the other one that we hear all the time on oil and gas, and I'm going to let you have a field day with this one. Green energy is going to eliminate the need for oil and gas, Ian, forever. We're not going to need this stuff 10, 15 years from now. We're not going to burn this dirty stuff anymore. What do you say to folks that say that as a deterrent for them investing?
I think I obviously I'm in the industry, and so and you're perpetually optimistic when you're in any industry that real estate, oil and gas, that has the cyclical nature of it. But I think that is there a need for green energy? Yeah, there is. We need more energy. Our society needs more energy. There's whether we like it or not, there's a supply demand problem, and we got to learn to conquer that. But to think that there is going to be a replacement for cheap energy that can help not only our country develop, but really the countries that are really driving the worldwide economy right now are third world countries that are moving into that are becoming more civilized, and they need cheap, reliable energy, and that's what oil and gas provides. And so I always joke, if we're really going to move into a society that has no fossil fuels, you're going to essentially have to wear no clothes and sit in a field with nothing around you, and to truly say that I have no fossil fuel exposure. You drive a Tesla, and the predominant how they create electricity is still predominantly from natural gas. Right? So it's like it's the overall thought process in green is I can't complain about it. I'm always I'm a believer in in the Charles Koch philosophy is you always have to understand the replacement and make sure you're trying to position yourself correctly. But I just think it's kind of a silly argument to think that there's anything that's going to happen in the near term that is going to change the need for cheap, reliable energy.
Yeah, that's the point that I wanted you to overarchingly make, was it's just not practical. Mm-hmm. The way that it's being discussed on the extremes in our political system, it's not practical that we can achieve that. Nothing particularly wrong with it, but we have to understand that the majority of oil and gas production isn't even used in cars, right? It's used in the production of other goods and materials. That kind of shift is more than just putting electrical chargers along the highway. Like, we're talking about a societal, 100, 200, 500 year change that needs to really get there.
Yeah. I mean, I don't pretend to be the world's best economist, right? And I spend my fair share, you do too, of trying to understand and being educated on the topic. And I've spent a long time, I guess, in the financial sector. But yeah, there is a need for energy, right? How are we going to get more energy, right? That's really what it's about in my mind, is we need more energy. And, even somebody like Elon Musk is the first to say that, we're not getting rid of oil and gas, right? We need more sources of energy to reach demand and to help growth, right? And, and I just think it's kind of a silly argument to think that we can overnight snap our fingers and this ESG movement will solve everything. And you're starting to see some of these ESG mandates in the financial sector not work, right? And so I'm sure everything like any other investment, you're going to have it's a cyclical nature. Everybody's moving to ESG right now because it's a hot topic, and everybody wants to play like it's they're an altruist that's doing it for the right reasons, but they're not. They're doing it to make money, and once they realize they can't make the money they need to make in the ESG movement, then they're going to end up pivoting and moving their money somewhere else. So
there'll be a new acronym for us to deal with. But no, well,
yeah.
On that, oil and gas isn't going anywhere. We need it. We need more energy, and it's a place that we should definitely look at. If again, as we talked about, this is a good diversifier, I think, for most of our clients. Hell, it's a dang good place to think about what place to make money. And the tax benefits are off the wall. They really are, on the working interest side. We haven't seen anything. Maybe somebody can find a better deal on the tax side that produces income in this way. I don't see it. So those are huge benefits for folks that it's worth exploring. They got to, no pun intended. They got to look into this.
Yeah. And you get to buy it. You get to invest in an asset, and then the investment that you make, you essentially get to write off almost all of it in the first year. I guess the last component of the tax stuff is accelerated depreciation right now has been incredibly nifty. Yeah. And actually in 2022, you were able to deduct 100% of your development costs. This year it's 80%. So while you get that 70% IDCs, that other remaining 30%, you can still deduct at 80% clip. So right now you're getting let's call it close to 90% of your development cost as deducts, and hopefully this accelerated depreciation will be something that our Congress, our government will extend. We'll see.
Yeah, that's an interesting one, and we talk about a lot of the bonus depreciation a lot in real estate, and so folks, it's here too in oil and gas. As people have been touting that, like, hey, look at this, and well, it's here too, and it's almost a sideshow compared to the rest of the tax benefits that we're getting. But yeah, in the bonus depreciation, we do need Congress and the House and President to rewrite or to reenact those laws as they're going to roll off naturally, and be gone naturally. So we'll see if folks do that, but you don't need them, frankly, to do it. It'd be nice if they do it here, but do you need them to?
I mean, you're already getting 70% regardless, right? But it's every bit helps when you're trying to reduce your tax burden.
It's the icing on top of the icing with 5 cherries or something. Like it's
yeah.
There's a cake under there somewhere too, but there's a lot of good. Ian, thank you so much for joining us and walking folks through this. It's been extremely helpful. Where can people find you? Where can they learn more about you?
Well, I mean, obviously they could reach out to you, give my contact information, or I'd love to field phone calls or emails. My email is ilang@locke.com, or my number is 918-398-4212. And I'd love to hear from anybody that has questions or or comments or an interest maybe in making an investment. It's I love talking shop. So it's it's even if somebody wants to call and just pick my brain, that'd be more than welcomed. Yeah, and you've been tremendously helpful for us as we've learned our way through this space. So I thank you for that, and generous in offering your time. It's been absolutely awesome. So this has been great. Thank you so much again for joining us, and thank you all for listening. Awesome. Thank you, Brandon.
Thank you.